Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
Yeah.
We've got a lot to dig into today, from AI predicting the market to Kim Kardashian shaking things up in the world of sneakers.
Oh, wow.
It seems like everything is connected these days, wouldn't you say?
Absolutely. It's fascinating how seemingly disparate events
Yeah.
can actually be intertwined in the world of finance.
Right.
We've got global trade tensions simmering, AI making waves, and even whispers of peace potentially impacting energy markets.
Yeah.
Buckle up, because it's going to be a wild ride today.
Speaking of a wild ride, let's start with this Market Watch article that really caught my eye.
Okay.
Apparently, some researchers are claiming that ChatGPT can predict stock market returns. I mean, come on, is that even possible?
Interesting.
Can a chatbot really have that kind of insight?
It's definitely raising eyebrows, and the research is surprisingly compelling.
Okay.
What these Chinese academics did was feed ChatGPT Wall Street Journal headlines from 1996 to 2022.
Wow.
The results, it was
Yeah.
able to identify positive economic trends and get this predicted market returns over a 6-month period with a decent degree of accuracy.
So it's not like ChatGPT is some kind of financial oracle, right?
Right.
It's more about how it can process information and spot patterns that humans might miss.
Exactly. Think of it as a highly sophisticated pattern recognition tool.
Okay.
It can sift through massive amounts of data,
Yeah.
in this case news headlines, and identify subtle cues that might point to positive economic developments. These are the kinds of cues that often get overlooked in the daily market noise, even by seasoned investors.
This is where it gets interesting for me and probably for you listening too.
Yeah.
The article suggests that this type of AI analysis could potentially help us identify undervalued stocks. That's a game changer, isn't it?
Potentially, yes. It's like having a digital assistant that can scan the financial landscape for hidden gems.
Right.
However, it's crucial to remember that AI, even as advanced as ChatGPT, is still a tool.
Sure.
It's not a replacement for human judgment and thorough research.
Right. It's not about blindly following AI predictions, but it could be a powerful addition to our research arsenal.
Absolutely. The key is to use it wisely, understand its limitations,
Yeah.
and always do your own due diligence before making any investment decisions.
Right.
And speaking of AI, the Market Watch article also mentioned another AI system called DeepSeek
Okay.
that didn't fare so well in predicting market returns.
So even in the world of AI, there are winners and losers.
Right.
What happened with DeepSeek? Was it just not as smart as ChatGPT?
It's not about intelligence per se.
Okay.
It seems that context and training data play a crucial role in how effectively these AI systems can analyze information. DeepSeek was primarily trained on Chinese language data,
Interesting.
which might explain why it struggled to make accurate predictions based on English language business news.
So the takeaway here is that even with AI, the devil is in the details.
Yeah.
You need the right data and the right context to get meaningful insights.
Precisely, it's a reminder that we're still in the early stages of understanding how AI can be applied to finance.
Right.
There's a lot of potential, but also a lot of room for improvement and refinement.
Well, let's shift gears now and talk about something a little more familiar, good old-fashioned trade wars.
Okay.
An article in Bloomberg caught my attention talking about how former President Trump is considering slapping a 25% tariff
Wow.
on imports of auto semiconductors and pharmaceuticals.
Really?
Didn't we leave all this behind in 2020?
It seems those familiar tensions are resurfacing.
Yeah.
MarketWatch noted some initial nervousness in the markets, but it's more of a wait-and-see approach for now.
Okay.
Investors are trying to gauge how serious this proposal is and what the potential fallout might be.
This is a big deal, though, right? I mean, a 25% tariff on such crucial industries could have a ripple effect throughout the global economy.
It is.
How should our listeners be thinking about this in terms of their portfolios?
It's definitely a situation to monitor closely.
Okay.
If you're holding stocks in companies that heavily rely on imports or exports in these sectors,
Right.
particularly the semiconductor industry, you might want to revisit your investment strategy.
Yeah.
This is a prime example of how seemingly distant political maneuvers
Yep.
can directly impact your personal finances.
It's a wake-up call for all of us to pay attention to global events, even if they seem unrelated to our daily lives.
For sure.
Trade wars have a way of spilling over, don't they?
Absolutely. These tariffs, if implemented, could trigger retaliatory measures from other countries,
Right.
leading to a spiral of protectionist policies that ultimately harm global economic growth.
Yeah.
This uncertainty and volatility are never good news for investors.
Okay, so we've gone from AI predicting the market to the potential return of trade wars. What a roller coaster.
Wow.
And speaking of roller coasters, let's talk about energy markets.
Okay.
Bloomberg also had an interesting piece about how peace talks between Russia and Ukraine are impacting natural gas stocks.
This is where things get a little complex. There's talk of a peace trade emerging with natural gas prices falling as peace talks gain momentum.
Interesting.
It's a good sign for Europe, which has been grappling with an energy crisis since Russia invaded Ukraine.
But what about for investors in companies like Cheniere Energy, the U.S. gas giant?
Right.
I read in Bloomberg that cheaper gas could be bad news for them. Didn't their stock prices soar because of the high demand for U.S. liquefied natural gas or LNG in Europe?
That's right. If peace prevails and tensions ease,
Yeah.
the demand for U.S. LNG could decrease, potentially impacting the profitability and stock prices of companies like Cheniere.
But even if peace does break out, which we all hope for,
Yeah,
hasn't this war highlighted the importance of energy security?
it has.
Won't European countries still be looking to diversify their energy sources and reduce their reliance on Russia?
That's a valid point.
Yeah.
The war has exposed vulnerabilities in Europe's energy infrastructure, and the push for energy independence will likely continue. This could mean a sustained demand for U.S. LNG, even in a post-war scenario.
So it's a bit of a mixed bag for energy investors, isn't it?
It is.
You've got the potential for peace pushing prices down, but also the long-term trend of Europe seeking alternative energy sources.
Exactly. And to add another layer of complexity,
Okay.
CNBC just reported disruptions to the Caspian Pipeline Consortium in Russia,
Oh, wow.
which could further impact global oil supply.
Wow. So many moving parts in the energy sector right now. It's like trying to solve a Rubik's Cube blindfolded.
I know, right?
What do you think? Where are the biggest opportunities or maybe risks for investors in this space right now?
That's the million-dollar question, isn't it?
It is.
The energy landscape is in constant flux with geopolitical event, technological advancements, and even climate change concerns all playing a role.
It sounds like we need a whole other deep dive just to unpack the energy
Heck,
sector.
probably do.
But for now, let's move on to something that might be a little less volatile, at least on the surface.
Okay.
The Wall Street Journal had an article about Coinbase, the cryptocurrency exchange.
Right.
And it wasn't about Bitcoin's latest price swings.
Interesting.
It was about an accounting change that shrunk their balance sheet significantly.
Oh, really?
This story really digs into the complexities of cryptocurrency ownership.
Yeah.
What Coinbase did was make an accounting shift that removed customer crypto assets from its balance sheet. This raises a critical question.
Yeah.
In the event of a bankruptcy, do those assets actually belong to the customers?
Right.
Or do they become part of the company's estate?
That's the scary thought of anyone holding crypto on an exchange.
That's a scary thought for anyone holding crypto on an exchange.
Absolutely.
So is my Bitcoin really mine or is it Coinbase's?
That's the gray area we're dealing with.
Okay.
The SEC's previous accounting rules suggested that in a bankruptcy customer, crypto could be considered part of the company's assets.
But the WSJ article mentioned that the SEC actually rescinded that rule earlier this year,
Right.
allowing Coinbase to make this accounting change. That sounds like a win for customers, right?
It's not that straightforward. The decision was met with a lot of pushback, with some arguing that it creates too much uncertainty for investors. Mainstream banks, for example, are still wary of getting involved in crypto custody because of the lack of clear regulatory guidelines.
It seems like the crypto world is always one step ahead of regulators, doesn't it?
It's a classic case of innovation outcasing regulation.
Right.
This situation underscores a fundamental question for you as an investor.
Okay.
How comfortable are you with the level of regulatory uncertainty in the crypto space?
It's a risk that definitely needs to be factored in.
Absolutely.
But hey, let's end this segment on a slightly lighter note.
Okay.
The Wall Street Journal also reported that HSBC is planning more share buybacks and cost cuts,
Right.
which usually signals a company is looking to streamline and boost shareholder value.
Yeah.
What's your take on that?
This could be a positive sign for investors.
Okay.
It suggests that HSBC is taking proactive steps to adapt to the changing global landscape. They're consolidating operations and focusing on key markets,
Right.
which could translate into increased efficiency and profitability down the line.
It's good to see a company taking charge in a world that feels increasingly unpredictable.
For sure.
And now for something completely different.
Oh, okay.
MarketWatch reported that the CEO of Shift4 Payments is stepping down to wait for it head NASA.
Wow. Talk about a career change.
Talk about a career change.
Right.
It speaks to the diverse paths that successful business leaders can take. And it's a great reminder that sometimes pursuing your passions means taking a leap of faith.
You got it.
It's inspiring, really.
Absolutely.
And for a little pop culture twist,
Okay.
MarketWatch also mentioned that Nike is partnering with Kim Kardashian's Skims brand.
Wow.
They're aiming to tap into a new market and appeal to more female customers. Do you think this unexpected duo will be a slam dunk?
It's a bold move, and only time will tell if it pays off.
Yeah.
Nike has faced criticism for not doing enough to cater to female athletes and consumers.
Right.
Partnering with Skins, a brand known for its focus on body positivity and inclusivity,
Yeah.
could be a strategic way to address those concerns and broaden their appeal.
It's fascinating to see how even a sportswear giant like Nike is navigating the evolving landscape of consumer preferences and brand partnerships.
It is.
But we've covered a lot of ground already today.
We have. We've studied from the depths of AI and global trade wars to the heights of corporate shakeups and celebrity collaborations.
Wow.
And we're not done yet.
That's right. When we come back, we'll take a closer look at some of the key insights from these stories and what they might mean for you, our listeners. Stay tuned.
Sounds good. Welcome back. Let's unpack some of the key insights we've gleaned from these headlines.
Sounds good. Where should we start?
Let's revisit that AI story from MarketWatch about ChatGPT predicting market returns.
Okay.
The fact that it could sift through all those Wall Street Journal headlines and pinpoint positive economic cues is pretty remarkable.
It's almost like having a sixth sense for market trends, wouldn't you say?
In a way, yes. This kind of AI analysis has the potential to be an incredibly valuable tool for investors who are willing to embrace it.
Right.
It's all about finding those subtle signals that often get lost in the daily deluge of information.
I'm curious, though. Could this kind of technology actually level the playing field for individual investors?
Interesting question.
I mean, in the past, it's always felt like the big institutions had access to better data and more sophisticated tools.
That's a really interesting point. The accessibility of AI tools like ChatGPT could indeed give individual investors a leg up. Imagine having the ability to analyze news and financial data in a way that was previously only available to hedge funds and Wall Street giants.
Yeah.
It's certainly a development worth watching.
Absolutely. But as you said earlier, it's not about replacing human judgment.
Right.
It's about using these tools wisely and understanding their limitations.
Precisely, AI can provide insights,
Yeah.
but it's still up to the investor to interpret those insights.
Right.
Direct further research and make informed decisions. Speaking of informed decisions, let's circle back to those potential tariffs we discussed earlier.
Okay.
The Bloomberg article mentioned that former President Trump is considering a 25% hike on imports of auto semiconductors and pharmaceuticals that could be a game changer for several industries, couldn't it?
Absolutely. And it's not just about the companies that directly import or export these goods.
Right.
The ripple effects could be felt throughout the supply chain and even impact consumer prices.
Exactly. For example, a 25% tariff on auto imports could significantly impact the profitability of foreign car manufacturers operating in the U.S.
Wow.
That could lead to higher prices for consumers, potentially affecting demand and overall sales. We could see a domino effect across the entire auto industry.
It's a reminder that everything in the global economy is interconnected. These tariffs, if implemented,
Right.
could have unintended consequences that reach far beyond their intended targets.
And let's not forget the potential for retaliation.
Right.
If other countries respond with their own tariffs, we could be looking at a trade war that could damage global economic growth. It's a scenario that investors should be watching very closely.
Definitely uncertainty and volatility are never good for market sentiment. Okay, let's shift gears to the energy sector, which, as we discussed, is in a state of flux. Right now, we talked about the peace trade emerging with natural gas prices falling on hopes of a resolution between Russia and Ukraine. But even if peace does prevail, the war has exposed some major vulnerabilities in Europe's energy infrastructure.
You're right. The reliance on a single supplier for energy has proven to be a risky strategy. That's why we're seeing a renewed push for energy independence in Europe. This could create some interesting opportunities for companies investing in renewable energy, alternative energy infrastructure, and even nuclear power.
The Bloomberg article also touched on the potential impact on U.S. LNG exporters like Chimere Energy.
Right.
Cheaper gas might hurt their bottom line in the short term.
Yeah.
But the long-term trend seems to be moving towards diversification and finding alternatives to Russian energy sources.
It's a classic case of short-term pain, long-term gain, and let's not forget about those disruptions to the Caspian pipeline we heard about from CNBC.
Right.
That adds another layer of uncertainty to the global oil supply.
It seems like the energy sector is a roller coaster right now with so many factors at play. It's tough to predict where things are headed. But one thing is, for sure, energy security and the transition to cleaner energy sources are going to be dominant themes in the years to come.
Absolutely, and these themes will create both challenges and opportunities for investors. Now let's move on to the cryptocurrency world. The Wall Street Journal's article about Coinbase's accounting change really raised some eyebrows, particularly the question of whether customer assets are truly protected in the event of bankruptcy.
It's a question that's been swirling around the crypto community for years, hasn't it? Are digital assets really ours if they're held on an exchange?
It's a valid concern, and the regulatory landscape is still evolving. While the SEC's recent decision to allow Coinbase to remove customer assets from its balance sheet might seem like a win for consumers,
Right.
It also highlights the lack of clarity and precedent in this space.
It seems like the legal and regulatory frameworks are struggling to keep up with the rapid pace of innovation in the crypto world.
That's precisely the challenge. We're dealing with a decentralized and borderless technology that doesn't fit neatly into traditional financial frameworks.
Uh-huh.
This creates uncertainty for investors and makes it difficult for regulators to establish clear guidelines.
So what does this all mean for someone who's thinking about investing in crypto? Is it just too risky given the lack of regulatory clarity?
It's certainly a risk that needs to be carefully considered. Choosing reputable exchanges with strong financial track records and clear terms of service regarding asset ownership is crucial. And diversification is key, just as it is with any investment. Don't put all your eggs in one basket, so to speak.
Sound advice. Okay, let's wrap up this segment with a bit of a corporate shakeup and a touch of celebrity intrigue. We talked about HSBC's plans for share buybacks and cost cuts, which are generally seen as positive signals for investors.
Yeah.
But then we had the CEO of Shift4 Payments deciding to head to NASA. That's got to be one for the history books.
It's a reminder that the corporate world can be just as unpredictable and exciting as any other field, and it's always inspiring to see someone pursue their passions, even if it means taking a completely different path.
Speaking of unexpected paths, Nike's partnership with Kim Kardashian's Skims brand is an interesting example of how companies are trying to stay ahead of the curve and appeal to new demographics.
It's a bold move, and it'll be fascinating to see how it plays out. Nike has been making efforts to diversify its brand image and connect with female consumers.
Right.
And this partnership could be a significant step in that direction.
It's a reminder that even in a world of constant change and disruption, companies need to be adaptable, innovative, and willing to take risks to stay relevant. But I think we've covered enough ground for now.
We've explored the implications of AI in finance, the potential return of trade wars, the complex dynamics of the energy sector, the evolving landscape of cryptocurrency regulation, and even touched on some surprising corporate moves.
It's been quite a journey, but we're not finished yet. When we come back, we'll wrap things up with some final thoughts and key takeaways for our listeners. We're back for the final leg of our deep dive into today's financial headlines. It's amazing how we started with AI predicting the stock market and ended up talking about Kim Kardashian and sneakers who knew finance could be so glamorous.
It's all connected, isn't it? From algorithms analyzing Wall Street Journal headlines to a reality TV star shaking up the footwear industry. It seems like everything is influencing everything else these days.
It's a reminder that as investors, we can't afford to have tunnel vision. We need to be aware of the broader trends shaping the financial landscape, even those that might seem unrelated at first glance.
Absolutely. In a world overflowing with information, the ability to connect the dots and see the bigger picture is essential. That's what allows us to identify potential risks and opportunities and make more informed decisions.
So what are some of the key takeaways from our deep dive today? What should our listeners be thinking about as they navigate this complex financial world?
Well, first and foremost, we're living in an era of rapid technological advancement, and AI is playing an increasingly prominent role. Tools like ChatGPT are changing the way we analyze information and potentially even how we invest.
That doesn't mean we should all rush out and buy whatever ChatGPT tells us to, right?
Of course not, but it does mean we need to be aware of these advancements and how they might impact the markets. It's about staying informed, embracing innovation, but also understanding the limitations of these technologies.
And speaking of limitations, we can't ignore the human element. As you said earlier, AI can provide insights, but it's still up to us to interpret those insights, do our own research, and make our own decisions.
Precisely, human judgment, critical thinking, and a healthy dose of skepticism are more important than ever in this age of algorithms and automation.
Another key takeaway is that globalization is here to stay, and with it comes a complex web of interconnections. We saw that with the potential return of trade wars and the ripple effects those tariffs could have on various industries and even the global economy.
It's a reminder that seemingly isolated events can have far-reaching consequences. As investors, we need to be aware of these interconnections and think globally, even if we're investing locally.
And let's not forget about the energy sector, which is undergoing a major transformation right now. The war in Ukraine has highlighted the importance of energy security, and the transition to cleaner and more sustainable energy sources is gaining momentum.
This is a space that's ripe with both opportunities and challenges. Investors need to stay informed about the geopolitical factors, technological advancements, and policy changes that are shaping this dynamic sector.
And then there's the world of cryptocurrency, which continues to evolve at a dizzying pace. The regulatory landscape is still catching up, and investors need to be aware of the risks associated with this emerging asset class.
Choosing reputable exchanges, doing your research, and diversifying your portfolio are crucial steps to mitigating those risks. And as with any investment, it's essential to only invest what you can afford to lose.
Words of wisdom. So it seems like the key to navigating today's financial landscape is to Stay informed, be adaptable, and embrace change. It's about using the tools at our disposal wisely, but never forgetting the importance of human judgment and critical thinking.
Well said, and perhaps most importantly, it's about being curious, asking questions, and never stopping learning. The financial world is constantly evolving, and the more we understand about the forces driving it, the better equipped we'll be to make sound decisions.
Great advice. And on that note, we want to thank you for joining us on this Wednesday morning deep dive into the financial headlines. We hope you found it informative and insightful.
We enjoyed unpacking these complex topics with you, and we encourage you to continue exploring these trends and developments on your own.
Remember, knowledge is power, especially when it comes to your finances. And we'll be back tomorrow morning with a fresh batch of headlines from major financial magazines. See you then.